Hey there, everyone. Dave Keller here with Market Misbehavior, President and Chief Strategist of Sierra Alpha Research, and thanks so much for joining me here on my weekly show on Stockcharts TV. Today we're going to be talking about downside objectives for the S&P 500. We've been highlighting in our content over the last couple months these early signs of rotation from November and December to more structural changes that we've observed in January and February as defensive sectors have started to outperform and previous leadership like the Magnificent Seven names have started to struggle. Now, in the last week or two, we're starting to see some confirmed signs of a breakdown. Those have accelerated to the downside this week with Trump tariff announcements and general risk-off behavior across the equity space and in other assets as well. What we're going to talk today is focusing on the S&P 500 itself. I was taught by one of my early mentors, Ralph Akampora, if you know nothing else about the markets, know the daily chart of the S&P 500. And inspired by Ralph's advice years ago in my formative years as a technical analyst, we're going to spend our time today talking about the S&P 500. Kind of three things we're going to talk about. Number one, how did we get here? We'll talk about sort of the general rotation using my market trend model. We'll also talk about some of the leadership rotations just to summarize how the conditions have evolved really over the last couple months, but have really accelerated here in the last week or two. Then we'll talk about the current setup of the S&P 500. Now that that line in the sand that we've been talking about, 5850, is now in the rearview mirror, what's next? And how can we identify some potential downside targets using different tools within the technical toolkit? Finally, we'll talk about how we navigate some sort of corrective period, particularly how could we tell when a corrective period may be ending. There's going to be a lot of speculation about where the market goes from here and which levels and at what date it's going to happen. I found letting the chart tell you when things are changing is much better than you telling the chart what you think is going to happen. So let's go through those three and let's start with the big picture environment and sort of making sense of where things are at. How did we get here? Well, when I talk about trends in the S&P 500, I like to start with my market trend model. This is a model that I designed years ago and really have become very reliant on it to help me define the trend on the different timeframes that are of interest to me. So there's three timeframes that we're listing out here. The long term, which is essentially over a year, generally speaking. The medium term model is a couple months, and the short term model is a couple weeks to a month. That's generally the time frames that I'm thinking of, and that's not a predictive model, right? This isn't telling you what the trend is going to be a month from now. This is telling you what the trend is, where it is, and the logic there is that trend following tends to work, right? Generally, if you can just stay on the right side of the major trends, you're going to do well, and I feel like that is where a lot of individual investors kind of get things wrong. You spend way too much time trying to pick a bottom, pick a top, celebrate when you sold at the perfect time, celebrate when you buy at the right time. Usually that doesn't happen. And I would say trying to pinpoint those turns, it's a fool's errand at best a lot of times. And it's very hard to get right consistently. So instead of trying to predict the future, let's just pay attention to the present. I think that's where a lot of investors get into trouble. They ignore clear signs that things have changed. And that is one of the worst things you can do. One of my mentors at Fidelity, my former bosses, used to say, it's okay to be wrong, but it's not okay to stay wrong. So what is the trend telling us now? Well, at the beginning of this year, we started January with a short-term model that was bearish because we just pulled back a little bit going into the end of the year. If you remember, late December. The medium-term model for me remained bullish and actually turned bullish in early November of 2023, and it remained bullish all through the entirety of calendar year 2024. Our long-term model turned bullish in March of 2023 and again has remained bullish through last Friday. And as a reminder, I update my market trend model every Friday after the close, so I don't really change it during the week. The model does fluctuate during the week, and that's just a placeholder until we can lock in the official value after Friday's close. So looking at the chart here, you can see that the short-term model more recently turned bullish in January, but then turned back bearish last Friday. So that's actually last Friday's close that pushed the short-term model bearish for the first time in 2025. And for the record, we can see that the short-term model actually turned bearish 5 different times in 2024. Each of those ended up being very, very buyable dips, within the longer term uptrend phase. So what happened in 2024 was we had a series of short-term bearish signals, but no medium-term bearish signals. So the medium-term model remained bullish. So that's what it looks like when the market is having a pullback within a primary uptrend. Now, if you have the short-term and the medium-term models turn negative, that suggests to me this is something different, and that's what we may be seeing today. So as of today, Tuesday, and really on Monday, the medium-term model did break below the zero level. As a reminder, as of last Friday, it was still bullish. So I wait until this coming Friday to lock in any formal change to the model. But barring some huge recovery through the remainder of this week, most likely the medium-term model turns bearish. And for the record, they're already bearish on the mid-cap and small-cap versions of the market trend model. Now, the long-term model is still bullish. So what this is going to suggest to us, if this does turn negative, is secular bullish trend, which I don't have a problem with, cyclical bearish trend, and tactical bearish trend. So short-term bearish, medium-term bearish, long-term still bullish. And that's about what this market feels like. But as a reminder, what was different and what may be different and what we're observing now is that the trends have now pulled back enough that it's enough for my medium-term model to turn negative, which doesn't happen in cyclical bull market phases. Now, one of the other things that I often look for to confirm that something's different, right? And you think about 2024 dominated by mega cap growth stocks like the Magnificent Seven names, defensive sectors just not doing well at all. That has started to change as well. If you look at these four series, this is the relative performance of four defensive sectors. So simply a ratio of the sector ETF versus the S&P 500. If the line's going up, that sector is outperforming the S&P. If the line's going down, it's underperforming. You can see that for most of the last 2 years, utilities, healthcare, consumer staples, and real estate, the four kind of defensive sectors in the US, have generally underperformed, with some notable exceptions, particularly July, August. That was a pretty decent pullback for the S&P 500 until we resolved to the upside August into September. But if you look year to date, the far right side of that chart, you can see that all four of those sectors have really started to outperform. Utilities, healthcare, consumer staples, real estate this week are making new relative highs for the year. So that is something we actually did not see in the fourth quarter of last year, as we were seeing potential signs of exhaustion, particularly bearish momentum divergences, bearish breadth indicators, many of which we covered here on Stockcharts TV and in my own content on my Market Misbehavior YouTube channel. Now all of a sudden we're seeing a different look and feel to this market in 2025. And that rotation away from growth leadership from 2024 and into more defensive and value-oriented leadership in 2025 has really accelerated in the last couple of weeks. And the tariff decisions, all the geopolitical things, all of the events that we've heard out of Washington and elsewhere have really helped to accelerate that rotation to more of a risk-off positioning. So that is the situation going into today as we look at the daily chart of the S&P 500. Again, I was taught, when in doubt, zoom out. So if you're wondering what's happening in the short-term environment, I found it's really helpful to start with a larger framework, where start with the big picture, think about where we've come from, then analyze the current markets, then think about what might come next. And that's the progression we're following in today's episode. So now that we've talked about we've had the appetizer, let's have the main course, which is the S&P 500 today. Let's look at the daily chart of the S&P 500. I should note that pretty much all of the charts, most of the charts I'm going to show you here today, are part of my Market Misbehavior live chart list. You can access these charts live on the Stockcharts platform. Just go to marketmisbehavior.com/charts, and we'll have a link in the description. You can get there directly. I keep those charts updated on my own login, so you can check them out at any point. Save that URL. Even if you're not a Stockcharts member, you can still see live versions of the chart. I would strongly encourage you to be a paid Stockcharts member, however, because then you actually can save them to your own chart list. You can edit them, add to them, subtract to them, whatever you want to do, and incorporate them more into your own workflow and your own exercises of market awareness. So here is the daily chart of the S&P 500, more and more looking like a massive double topping kind of pattern, although we had a number of tests of that 6,100 level going back to early December. When we hit 6,100 for the first time, then we failed to get above there in mid-January, failed again in late January, failed again in early February, failed again in mid-February most recently, and now we're breaking down out of this range to the downside. Now for us, 5850 was a key line in the sand. So when you have a market that is making new all-time highs, you're bullish, right? Or at least you should be, in my opinion, right? Barring, again, paying attention to divergences and other signs of exhaustion. As long as the trend keeps going up, I'm going to want to follow that trend higher, right? That's key to trend following. So, warning signs are when we stop making new highs. And really, the last new all-time high we really made was in early December. I would consider the January and February highs failed attempts to break above 6,100 and sustain that breakout. So I would say the uptrend phase really exhausted in December. From December, really November, December through now February, we're in a sideways or consolidation phase. Now with the break below 5850, I would argue we're most likely at the beginning of a distribution phase. So what confirms that? So, a couple things to observe. Remember, at the end of last week, the S&P was around 5,900, 5,950. That's literally exactly where we were on the day after the elections in early November. So we gapped higher after the Trump presidency confirmed. From there, we've chopped around a bit, but really haven't gone anywhere, right? Draw a straight line from November 8th through the end of February, and we're kind of right at the same price range. So again, a reminder that we've really been in a sideways phase here for a couple months. Now, when you have a sideways trend, I think you have clear resistance, 6,100. You have clear support, 5,850. That goes back to the lower end of this price gap, the initial pullback after the gap higher in mid-November. That lines up pretty well with the lows in mid-December and late December. I would consider the breakdown in January a failed breakdown of that support level, similar to the failed breakout that we observed in February. So more and more confirming that 5,850 is pretty important. Even going over the last week, we traded down right to 5850 and then had a big up day immediately afterwards, and that was on Friday of last week before Monday's sell-off and then Tuesday's initial follow-through below 5850. So, again, barring a huge rally going into today's close or on tomorrow's session, it looks like 5850 has now been broken. So other things to think about on the daily chart of the S&P 500, the 200-day moving average is now very much in play, and we'll talk about that a little more in a moment. But the 200-day moving average has not been touched for quite some time, over a year. You can see we've traded, not exactly to it, but very, very close to it on today's trading session. And I would tell you is that if you look back to the August 24 low and take that to the December 24 high, and you think of that as a framework to apply Fibonacci retracements, 38.2% of the way back down to that August low is right around 57.20. That lines up pretty well with the swing low around Halloween of last year, late October, early November. You can see that lines up really well with exactly where we're at today. So the 200-day moving average is also at a confluence of support with the 200-day and the first Fibonacci support level based on that framework. Other thing I would tell you on the daily chart is that the momentum, of course, has been deteriorating. Each new high through January and February has been marked by lower momentum readings, and most recently the RSI this week is pushing below 40. So the last couple tests of 6,100, the RSI stalled out around 60, which implies that the whole range of the RSI is starting to drift lower, which is more standard within a bear market phase. And all of a sudden the RSI is pushing below 40, and that's something that did not happen at some of these previous lows, but all of a sudden is starting to happen. So again, that tells me with a breakdown of 5850 on weaker momentum, with the RSI pushing below 40, that suggests to me again we're now in a new distribution phase. So that is where we're at right now. Now that 5850 is broken, the immediate support I'm looking at is sort of in that 5720 range, which is pretty much at today's lows. If that would not hold through the course of this week, 5,500 would be a 61.8% retracement of the way back down. That would take us back to the September 24 lows and would also be a pretty meaningful decline. The other way to measure this, by the way, and think about where we go, is take the height of this pattern. Take this basing pattern. It's about a 4 to 5% swing from 5850 up to 6100 or so, depending on what highs and lows you measure. If you take another 5% haircut off of that 5850 breakdown, you know where it gets you? Right around 5,500. So take the height of that pattern and subtract it from the breakdown, and that actually gives you a downside objective very similar to that 61.8% level. When I'm trying to project levels, when I'm trying to anticipate where we might find support, I found confluences of different indicators, right? Different indicators with different approaches all kind of coalesce at the same point. That to me sort of gives me greater confidence that that might be an important objective to watch. So I think of this as an if-then statement. You know, before it was if we break 58.50, we go to the 200-day. If the 200-day fails to hold, I'm looking at 5,500 as a potential downside target. That would be about a 10 or 11% drop from all-time highs, which if you look at market history is not that unreasonable, even in a pretty bullish environment over the long term. In secular bull markets, 5-10% declines are not that unreasonable and are actually a lot more common than we've experienced in recent market history. The third point we're going to talk about, now we've set the table. We had the appetizer, which was talking about market conditions going into this week. We had the main course, which is the daily chart of the S&P and identifying some key levels if we would continue to break down a little bit further where we might identify some support. Now the dessert course, right? The third course would be what can help us sort of validate that a low is in, right? I mean, and people will be telling you, I'm sure they are. I try not to pay attention to a lot of other technical analysts because I have to focus on my own work and my own perspective. But I mean, I would tell you a lot of people will probably be calling for a low today, right? A test of the 200-day. We're not going to get lower than that. I'm sure someone somewhere is saying that. You know, there might be very valid technical reasons how you can justify that. I don't want to discredit anything that they're saying. It could be very valid and could be proven correct. For me, though, I think once we've determined a market direction, I would say if we confirm that we're in a distribution phase, the question is, where do we find a bottom? And I think two ways you do that is, number one, use price objectives, right? You use the structure of the market to anticipate what levels may be important. That's what we talked about on the previous chart. Or we just use trend following devices, right? We use conformational tools to identify once a low happens that was the low. And this is the chart I'll probably be looking at if we do break below the 200-day moving average. This is a chart you'll probably see me use a lot more on my market recap show called Chart This and other places as well, because I think it could provide us a good opportunity. This is now looking at a 2-year chart of the S&P 500. I did a longer-term Fibonacci retracement level, by the way, just to give you an additional sort of perspective. And I did note if you take the August 23 low, which is arguably the most significant low we've seen here in the last couple years, and then take that to the high from just a couple weeks ago in mid-February, 38.2% using this framework would be around 5,400, just slightly below that September low. So the previous one gave us an objective around 5,500. So I'm thinking 54 to 5,500. That seems like a good general range to look for a potential buyable opportunity. But as we would get, if we would get down toward those levels, these are some other indicators that I would look at, particularly the one at the bottom, which is the PPO indicator. MACD and PPO are very similar, uses moving averages and uses the crossover technique, which is a common technique in the moving average space, to confirm when a low is in. And if you look back at some of the major pullbacks that we've experienced in 2004 and 2023, you'll notice that the PPO indicator often gets well below the zero level. Most recently, we saw that in January. We saw that in August of last year, in April of last year. Then you're going back to like the fourth quarter of 2023. Now, what helped us identify that some of these downtrend phases were now over and that we had an all clear of sorts telling us that we were probably embarking on a new bullish trend or a new uptrend phase? Well, the chain of events that I found looking at some of these tradable lows would be a PPO buy signal, followed by a break above the 50-day moving average, right? Breaking below the 50-day is usually a sign that things are getting, we're in a pullback phase, right? We're in a corrective move of some sort. And I think the likelihood of us going significantly further is certainly real. It's certainly there. But once we go lower, turn into a trend follower and just focus on when that trend of lower lows and lower highs stops. So a couple things we can do, right? We can take a trend line, taking the major highs. Let me just quickly draw some of these, right? So some of these trend lines have been really helpful just to sort of validate, all right, we're in a downtrend phase. All right, when is that downtrend phase over? I'm kind of drawing some of these. And again, every time we've broken above that trend line, that is usually the sign that we're in a recovery phase. If you look, when we break above those trend lines, we're also breaking back above the 50-day moving average. So, that sign that we're in a distribution phase, we're below the 50-day. All right, we finally break above the 50-day. after a PPO buy signal, right? So the PPO buy signal often happen right after a major low. You can see one happened here in like early October of 23. We didn't get above the 50-day, didn't get above that trend line. We're not there yet. We had another buy signal here end of October. We did break above the 50-day, did break above trendline resistance. That's a thumbs up. Here we had a PPO buy signal early May as we are breaking above the trend line and above the 50-day. That's a good one. Here we had the PPO buy signal in mid-August. We soon after broke above the trend line, broke above the 50-day. We're good. Most recently, we had that in mid-January when we broke above the trend line, broke above the 50-day, broken record. You can see what I'm getting at. So what would I be looking at here? Well, if we continue to break lower, we're in a distribution phase. I'm probably thinking defensively. I'm taking bets off the table and raising cash and focus on defensive positioning. I've already started that in my own portfolios, to be honest with you, to some degree. As we would continue lower, this is the type of chart. If I want to know, all right, when can I stop thinking more defensively? When can I start thinking more on offense? I would use this kind of chart looking at some of these previous lows, looking at the recovery, which involves a buy signal from a trend following indicator like the PPO, a break above trendline resistance, which tells us we're no longer making lower highs or in that downtrend. We're breaking back above the 50-day, which tells me in the short term we're appreciating enough to get above that short-term trend following mechanism. At the end of the day, though, I'm always going to go back to my market trend model. And if we do get a medium-term bearish signal, one thing I've learned because that means we're probably in a more significant decline than what we've seen previously, I look for the medium-term model to turn back bullish, and that has usually steered me right in helping me identify when the market has started to recover and help me think more on offense and less on defense. What do you think about some of those downside objectives using Fibonacci retracements, using support and resistance levels that we talked about? Do you have a different level in mind? Let me know. Drop a comment below and let me know. By the way, if you want to track some of these indicators along with me as we navigate these markets day in, day out, my daily market recap show is called Chart This with Dave Keller. You can find that on my YouTube channel called Market Misbehavior. We'll drop a comment below with the link on how to access that as well. I also have a market misbehavior podcast that I started at the end of last year. We're up around 30 episodes, I want to say. The last 2 episodes have been a lot of fun. I would encourage you to check out my interview with Jay Woods of Freedom Capital Markets in New York. Jay's awesome. He spent his career on the floor of the New York Stock Exchange, does such a fantastic job connecting the short-term noise, the short-term flickering ticks with the long-term perspective, and our conversation focused on actionable ideas given some of this market instability. We focused on the financial sector in one part, so I would encourage you to check that out. I also, my most recent episode was with Lindsay Bell. Lindsay's a fantastic investment strategist, more of a macro strategist, not a technical analyst. And I found it was a really interesting complementary discussion thinking about what we are seeing on the charts with some of the rotations, what she is seeing with the macroeconomic environment, with interest rates, with the Fed, and so much more. So make sure you check out those interviews as well on my YouTube channel called Market Misbehavior. That is it for today. Thanks so much for joining me here on today's episode on Stockcharts TV. I wish you guys well as we navigate these markets together. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.